Suppose that you wish to save for your child's higher education, which is due in next 15 years and cost around rupees 10 lakhs today. So you decided to save rupees 5,000 per month in your savings bank account. Now considering the educational inflation in India, that is around 8% per annum, let's see how much this cost of higher education will be after 15 years. So the present value is rupees 10 lakhs, inflation rate is 8% and duration is 15 years. So the cost of higher education will be 31 lakhs 72,000 after 15 years. Now let's see how much you have saved over these 15 years for this goal. In India, we usually get around 3 to 4% interest rate per annum in our savings bank account. So taking 4% as the interest rate and 5,000 per month as the amount, you have saved around rupees 12 lakh 34,000. As you can see, you have a shortfall of rupees 19 lakh 37,000 for your child's admission. To bridge this financial gap, either you need to increase your savings amount or invest for higher returns. The reason behind this shortfall is that inflation rate is more than the interest rate, and inflation decreases your purchasing power over time. So if an apple costs you around rupees 100 today, taking 6% inflation rate, the same apple will cost you around 106 after 1 year. And amount in your savings bank account earning 4% interest rate will be just rupees 104 after 1 year. So in real terms, you have lost 1.89% of your purchasing power. So we have understood that return on our invested amount must be more than the inflation rate. That's when our money will grow in real terms. So just saving your money is not enough to build wealth or achieve your financial goals of buying a car, owning a house, or your own retirement. To avoid any kind of monetary shock in your life, you need to plan your finances in advance and smartly by investing your saved amount. As investing provides you better returns, beats inflation, and provides benefits of compounding and makes your money work for you. Remember that you should not consider investing as a get rich quickly scheme as it involves potential risk and there are no guaranteed returns. So you must always keep funds for your emergency. Now let's see what are the various asset classes available for investors where they can invest their money. Equity. In equity we have stocks, ETFs, mutual funds and index funds. Second, fixed income instruments in which we have government bonds, corporate bonds, debentures, etc. Third, real estate, in which we have residential and commercial properties, REITs and InvITs. Fourth, commodities, in which we have gold, silver, metals, etc. And last, we have alternative investments, in which we have private equity, hedge funds, etc., which are suitable for investors who can invest a huge amount, usually in crores, and can take a lot of risk. There are other digital assets also like cryptocurrencies available. All of these asset classes have their own risk and return characteristics. Like equity is risky but provides higher returns, bonds provide you fixed income with safety, and real estate requires huge investment amount and are illiquid in nature. If you don't understand what are mutual funds, ETFs or REITs, don't worry, I will cover these topics in my upcoming videos, so don't forget to subscribe my channel Getting Ahead with Manisha. Now some of you might be thinking that savings in a bank account provides me safety, capital protection, liquidity, and also I don't need to have any kind of financial knowledge for that. Then why should I take risk by investing my money? Because
रिस्क है तो इश्क है.
now this dialogue is not enough to justify for taking risk with your hard-earned money. But as I have mentioned earlier, to grow your money in real terms and achieve your financial goals, you need to earn return more than the inflation rate. We cannot eliminate the risk out of investing, but we can manage it. And today we will discuss some key points to keep in mind while investing. And if you consider these factors in your financial planning, you might be able to reduce risk. Let's discuss them. First, try to list your goals that you wish to achieve, like your child's education, buying a house or a car, going on a vacation, or your own retirement, so that you can be financially independent after your retirement. Or it can also be just wealth creation. Next, write down the investment horizon of your goals. If you have near-term goals like buying a car in the next 2 years, then you should go with the less risky and liquid investments. But if you have long-term goals like your retirement, that is after 30 to 40 years, or your child's education, that is after 10 to 15 years, then you have time and you can take benefits of compounding. To understand how compounding works to build your wealth, check out my video on the power of compounding. The link is in the description. After that, consider your financial situation and your risk appetite. Determine your current financial situation, like what is your income, what are your expenses, how much amount you can save per month, and if you have any existing loans, prioritize paying off them as soon as possible, as compounding in debt works against you. Then determine your risk tolerance. If you want capital preservation and safety, then consider debt instruments. But for a younger individual with fewer liabilities and higher risk appetite, they might explore equity markets. So choose your asset classes based on your risk tolerance. After figuring out these factors for yourself, you can evaluate different asset classes available and find the one suitable for you. While choosing asset classes and preparing your portfolio, you need to consider other factors also, like asset characteristics. Each asset class has its own riskiness, expected return, liquidity, and taxation, and are suitable for different investment horizons. So you should choose that asset class which has characteristics that matches your requirements. So you cannot expect a very high return like that of equity from debt instruments, as they are less risky and liquid as compared to equity investments. Next factor is liquidity. Liquidity means how quickly you can convert your asset into cash without losing its fair value. For example, you should avoid illiquid investments such as property if you have short-term financial goals, as selling them quickly at a fair price can be difficult. Another factor is asset allocation, which means dividing your total investment across different asset classes like real estate, stocks, bonds, etc. We have different goals, and each goal has its own investment horizon and return requirements. So your different goals might need different asset classes. And importance of asset allocation moves us to our next important factor, that is diversification. Diversification means don't put all your eggs in one basket. So by dividing your investments across different asset classes, you have reduced your overall risk, as a well-diversified portfolio ensures that even if stocks decline, other assets like bond or gold may retain or increase in value, providing you stability. Next factor is expenses and return on investments. Fees and expenses can reduce your overall return over time. For example, if a mutual fund earns 10% return and has expense ratio of 2%, then your actual return is just 8%. So always check the net return that you are getting from that asset class after bearing the expenses. In the same way, consider tax implications also, as various asset classes have their own tax rates. So you must check the post-tax return of your investments. Our next factor is what we have been discussing in this video earlier, that is inflation. So your net return after considering all expenses and taxes must be more than the inflation rate, otherwise you are losing in real terms. Next factor is economic indicators like interest rate, inflation rate, government policies, and global events all affect investments. For example, if central bank raises interest rate, then fixed income instruments like bonds become more attractive as they provide higher returns. So understanding these economic indicators help you to adjust your portfolio accordingly. One more factor is rebalancing. That means adjusting your portfolio to ensure that it stays aligned with your financial goals and risk tolerance. But keep in mind that you should not rebalance your portfolio very frequently, as it can affect its performance due to higher taxes and expenses, and it can also disrupt your compounding. Last and most important factor, that is financial knowledge and research. Don't follow blindly the advices of your relatives and your friends. Do your own research, as the more you know, the better your decisions. That was all about the factors that you should not ignore while investing. If you like the video, hit that like button and subscribe to my channel. We'll see you soon with another financial topics. Thank you and keep learning.